Welcome to Simple Investing Secrets. In today's video, we'll review the 12 best stocks to buy in February 2023. So before we start, please like this video and subscribe to our channel for weekly updates. Let's get started. Stocks and investors have had a difficult year this past year. The three important indices entered bearish territory. Additionally, the Nasdaq has lost about 27% since the beginning of January. However, this period won't last forever. Eventually, bear markets are followed by bull markets. When this transition will take place is unknown. However, making plans for it is still a great idea. Particularly considering how many businesses with strong long-term narratives have seen their valuations collapse. And some players will soon experience exciting catalysts. Now is the time to put money into companies that can boost sales and do well when things get better. Stock market gains should eventually follow strong earnings performance. With that said, let's review our list of the 12 best stocks to buy in February 2023. Number 12. Halliburton, ticker, HAL. Halliburton is one of the world's largest energy services companies according to Argus Research, with more than 40,000 employees and operations in over 70 countries. It supplies products and services to assist in energy exploration and production, from locating the oil to constructing and completing the well to managing geological data. Oil was already in short supply as the global economy opened up post-pandemic. Then came the war in Ukraine. Halliburton stands to benefit as oil companies ramp up production. Jeffrey Miller, Halliburton's CEO, told analysts that it was entering a multi-year upcycle, according to Argus. The investment research firm expects Halliburton to generate strong free cash flow in the coming quarters and notes that the company nearly tripled its dividend. The shares trade at 15 times forward earnings estimates, well below the 5-year average of 26.5. Number 11. Advanced Micro Devices, ticker, AMD. Advanced Micro Devices is a leading semiconductor manufacturer. Analysts have mixed ratings on AMD in part because an economic slowdown and negative investor sentiment are near-term obstacles. The shares are currently trading at 16 times expected earnings for the coming year, which is more than half the typical price-earnings multiple over the past 10 years. The shares have decreased by about 50% from their 52-week high. Still, analysts on average expect a 25% jump in annual earnings over the next 3 to 5 years, according to S&P Global Market Intelligence, ahead of the company's peers. Fueled in part by market share gains for its data center chip sales climbed 45% in the most recent quarter compared with the year before. Analyst Vijay Rakesh, at Mizuho Securities USA, rates the semiconductor stock a buy and recently assigned the shares a 12-month price target of $95. Number 10. Disney, ticker, DIS. Disney has reached a big turning point. The entertainment giant has reported growth in its parks, experiences, and products business. And it's made great progress in signing on members to its streaming services, adding 57 million this year. But Disney is struggling with higher costs. And its shares have tumbled 36% in 2022. But here's the good news. Disney recently brought back longtime Chief Executive Officer Bob Iger. He's the one responsible for successes like the purchases of Pixar and Marvel. He is also the CEO behind the blockbuster film Frozen. Iger proved himself when it comes to general growth at Disney. During his tenure, market value, revenue, and profit climbed in the triple digits. All of this means he is probably the best person to put Disney back on the right track. The strength in the parks business is another bright spot. That business revenue rose 73% in the recently ended fiscal year. And parks, experiences, and products traditionally has contributed the most to the company's total revenue. Today, Disney trades for about half of what it was trading for earlier this year. That's in relation to forward earnings estimates. So now is a great time to get in on this recovery story in 2023. Number 9. Airbnb, ticker, ABNB. Airbnb short-term home and apartment rentals company Airbnb recorded impressive growth this year, with its revenue and net income rising at a healthy pace. Despite that, the stock saw a severe sell-off and is down 43% so far in 2022. Airbnb stock's decline means the stock trades at a relatively attractive valuation. Its price-to-sales ratio of 8 represents a nice discount to last year's multiple of nearly 20. Airbnb is also trading at 32 times forward earnings, compared to last year's multiple of 128. Given the company's robust growth and its ability to sustain its momentum in 2023, now would be a good time to buy Airbnb stock since it is trading at a cheaper valuation. After all, tourism spending is expected to increase in 2023. The Economist Intelligence Unit estimates that global tourism arrivals are on track to jump 30% next year, which should boost Airbnb's addressable market opportunity and help increase its top and bottom lines. It is worth noting that Airbnb witnessed a 25% year-over-year increase in nights and experiences booked in the third quarter to nearly 100 million, which led to a 29% increase in revenue over the prior year period to $2.9 billion. Analysts expect Airbnb to finish 2022 with $8.3 billion in revenue, and the company is estimated to record robust double-digit growth over the next couple of years as well. With Airbnb being a key player in the vacation rental space with a solid market share, it wouldn't be surprising to see the company meet or even exceed analysts' expectations. What's more, the company is expected to record annual earnings growth of 20% over the next 5 years. All this makes Airbnb a top stock to buy for 2023. Number 8. Johnson & Johnson, ticker, J&J. Johnson & Johnson is a company we all know well. The pharmaceutical giant sells brands we use it such as Band-Aid bandages and Aveeno bath products. They are part of the consumer health business. But J&J makes most of its revenue through its two other businesses, pharmaceuticals and medtech. That's where J&J plans on putting the focus as of next year. In 2023, J&J will spin off consumer health into a separate company called Kenvue. This means J&J can move forward and grow its most successful businesses. In the third quarter, pharmaceutical sales rose 9.2% in the third quarter and medtech climbed by 8%. That is, consumer health sales rose less than 5%. The big pharma player also is making moves to reinforce its strengths. It recently announced the acquisition of Abiomed. The medical device company makes pumps that help a failing heart recover. Abiomed has grown sales over about 18 years. J&J expects the deal to add to its adjusted earnings as of 2024. So, 2023 can be an excellent time to get in on the J&J story. Finally, you'll also want to buy J&J for its dividend. The company is part of a group called Dividend Kings. They've raised their dividends for at least the past 50 years. This means J&J can bring you share performance and growth in passive income. Number 7. Intuitive Surgical, ticker, ISRG. The world's foremost expert in robotic surgery is Intuitive Surgical. Due to hospitals delaying surgeries at certain times of the pandemic, revenue was still negatively impacted despite this leadership. The fact that hospitals must purchase equipment and supplies from Intuitive in order to use their robots during surgeries means that the company makes money off of each procedure. Surgery cancellation because of coronavirus hospitalizations is still a possibility. However, it appears to be less of one now than it was a year ago. And with this risk decreasing, Intuitive's future appears promising. Gains have already begun to show. Worldwide procedures increased by 20% in the third quarter. And sales increased by 11%. By repurchasing $1 billion worth of its common stock in the quarter, Intuitive also staked its future on it. Intuitive now has more than 7,300 Da Vinci surgical systems placed in hospitals worldwide. That's a 13% increase over the third quarter of last year. It's also important to note that robotic surgical systems cost about $1 million. So hospitals will likely use the system as long as possible, which should help Intuitive hold on to its leadership. Shares of Intuitive are currently trading at 55 times the estimated forward earnings. And earnings are increasing. 2023 seems like a great time to buy this healthcare stock, given Intuitive's position in the market and recent growth. Number 6. Nvidia, ticker, NVDA. Nvidia is an American multinational technology company based in Santa Clara, California. It is a software and fabless company that creates graphics processing units, GPUs, an API for high-performance computing and data science, and system-on-chip components for the mobile and automotive markets. In workstations for applications in media and entertainment, automotive, scientific research, and manufacturing design, its professional line of GPUs are employed. In addition, Nvidia is a global leader in artificial intelligence hardware and software. Nvidia's most recent results weren't all bad, as the company's data center division generated $3.81 billion, up 61% year-over-year, and notched a new quarterly record. The segment, which provides processors used in data centers, cloud computing, and artificial intelligence, remained remarkably resilient, even as businesses battened down the hatches for the continuing economic storm. The company continues to be the go-to provider for semiconductors that facilitate the movement of information around data centers and enable each primary cloud provider's vast cloud computing operations. Alphabet's Google Cloud, Amazon Web Services and Microsoft Azure rely on Nvidia's processors. Others include Baidu Cloud, Alibaba Cloud, and Tencent Cloud. When the US government recently banned sending high-end AI and data center chips to China, Nvidia quickly developed a semiconductor to meet its customers' needs while still complying with the newly issued government mandate. This was a critical step in protecting its cloud and data center business, representing the company's most significant growth area. While estimates vary, the cloud computing market is expected to surpass $480 billion in 2022. Achieving a compound annual growth rate of 19.9% over the next 7 years and growing to $1.7 trillion by 2029. The strength of this secular trend and its industry-leading position will continue to drive Nvidia's growth for years to come. There's little doubt that gaming and cloud computing are the company's most significant opportunities, but they're not the only ones. For example, Nvidia continues to be an essential player in the developing area of self-driving cars and trucks. We know developing fully autonomous vehicles will likely take longer than initially anticipated. Still, Nvidia is a crucial provider of the hardware and software necessary to enable this breakthrough technology. Nvidia is partnered with more than 120 movers and shakers in the industry, including car and truck makers, Tier 1 automotive suppliers, robotaxi services, simulation, mapping, sensor, and software companies. While the technology may not be ready for prime time, Nvidia is well positioned to benefit when it eventually makes the grade. This shows that while the current economy is weighing on Nvidia's results, the company is in good shape for a severe rebound once things improve. Nvidia had record-setting sales last year of $26.9 billion, which shows it's the current environment weighing on sales. However, that's a drop in the ocean compared to its total addressable market, which management estimates at more than $1 trillion. According to conventional valuation metrics, the stock of Nvidia is neither cheap now nor has it ever been. However, prices are lower than they have been in a while. Currently, it is trading for about 9 times what it will make in the following year. While most investors consider a reasonable price-to-sales ratio between 1 and 2, high-growth stocks typically deserve a higher premium, and Nvidia certainly falls into that category. The fact that Nvidia is the leader in not just one but 2 industries, has a large market it can sell to and has strong secular tailwinds gives it everything it needs to do well for years to come. That's why Nvidia is one of our top stocks for 2023 and beyond. Number 5. Amazon, ticker, AMZN. Amazon is a leader in 2 markets set to grow in the double digits this decade, e-commerce and cloud computing. These businesses have helped Amazon grow earnings into billions of dollars over time. But today's higher inflation and other troubles like supply chain issues have been weighing on Amazon. As a result, Amazon's reported declines in operating income and free cash flow has turned into an outflow. This is painful in the short term. The stock has slipped nearly 40% so far this year. The good news is the long-term picture remains bright. Amazon has the market position and financial resources to weather these times. The company's revenue still is growing. And members of its Prime membership program are spending more and more on Amazon. Amazon also is strengthening its cost structure. This will be a plus down the road. Today, Amazon shares are trading for around their cheapest in relation to sales in the past 6 years. So, the best deal this holiday season may be on Amazon shares. Number 4. Teladoc Health, ticker, TDOC. Teladoc Health sank 63% this year. The telemedicine leader disappointed investors with $2 billion non-cash goodwill impairment charges. This deepened investors' worries about the company's lack of profitability. But the most challenging times may be behind Teladoc. In the third quarter, Teladoc narrowed its net loss. The company's revenue and visits continued to climb in the double digits. And Teladoc said the deal size today was about 50% bigger than the average deal a year ago. Companies hurt by today's economic environment and coronavirus disruptions have taken longer than expected to finalize their Teladoc plans. These are temporary issues. And when the situation improves, Teladoc could see a clear rebound. The company has increased US member numbers and revenue per member from quarter to quarter. Right now, Teladoc shares are trading at 2.3 times sales. This is nearly their lowest ever by this measure. Considering growth prospects, now is an excellent time to get in on this recovery story. Number 3. Vertex Pharmaceuticals, ticker, VRTX. Vertex Pharmaceuticals is one of this year's stock market winners. The shares have advanced 38%. But Vertex may just be getting started. That's because the company is at a critical transition point. The biotech company is already a solid leader in the cystic fibrosis, CF, treatment market. The CF portfolio brings in billions of dollars in revenue and profit annually. But Vertex is about to expand into another significant treatment area. Vertex and partner CRISPR Therapeutics are submitting their candidate for blood disorders beta thalassemia and sickle cell disease to regulators in the US, Europe, and the UK. If all goes smoothly, the product could launch shortly. So Vertex has a clear catalyst ahead. Vertex's pipeline also includes other potentially significant products, such as candidates for pain management and type 1 diabetes. So a few years later, Vertex will still be a CF leader, but it may still carve out significant revenue opportunities in other markets. That's why it's a good idea to get in early on this innovative biotech player. Number 2. Costco, ticker, COST. Costco shares have outperformed the market this year. But they've still lost about 9%. This means they're less expensive in relation to forward earnings estimates than they were earlier in the year. What's another reason to buy Costco now? Today's economic woes work in Costco's favor. That's because the company sells items in bulk and at dirt cheap prices. So as shoppers watch their budgets this holiday season, they may favor buying at a place like Costco and taking advantage of their membership. You pay an annual fee to shop at Costco. So it's to your advantage to do as much of your shopping there as possible. Beyond troubled economic times, this annual fee plays a crucial role in Costco's success. Number 1. Microsoft, ticker, MSFT. One of the largest names in tech, Microsoft is one stock to keep an eye on. While some might expect to see Apple headline this list, we didn't include it. For Apple's part, it does not generate the kind of strong margins Microsoft does, nor does it have as good a growth rate. Consensus estimates call for just 4% earnings growth this year, fiscal 2023, but an acceleration up to 17% growth in fiscal year 2024. For the company's revenue, estimates call for 7.2% and 13% growth this year and next year, respectively. On the plus side, Microsoft is still forecast to grow. That's even as some investors might not assume that's the case, given that shares suffered a peak-to-trough decline of 39% and are still down 29% from highs. This concludes our list of the 12 best stocks to buy in February 2023. As always, it is essential to do your due diligence before committing your hard-earned cash to buying stocks or investing in the market. Don't forget to like this video and subscribe to our channel for weekly updates on the best stocks to buy and cutting-edge investment strategies for building wealth. Thank you for watching, and best of luck with your investments.